Hello, class. We are going to talk a little bit now about pricing construction equipment. From the previous module, we talked about pricing in general, and as we go forward, we're going to just kind of break things down a little bit more and understand that the information that we're doing right now in your modules is going to help build up to helping you with your semester project. And this is just really an overview, and we'll get more into the details as we're working on your project. And I believe all this is going to come together at the end, okay? So let's talk about pricing construction equipment. These are our objectives that we have for this module, and as you can see, there's a lot. And so in general, what I want to do is I want to first just talk about the main key points as far as pricing equipment. And then I want to get into providing a few calculations so that you can understand a few methods when it comes to depreciation of equipment. And then we'll talk about some additional things that you would probably see on your bid summary when you turn it in for a project. The reason why you'll see that is because you're going to have some additional markups. If you don't include those additional allowances, you're going to find that you're probably going to have some problems winning a job. And on top of that, you want to make sure that you make a profit for all the projects that you bid on. So we have to think about the additional allowances, the contingencies, various things that we have in place, such as the overhead, and the list just kind of goes on from there. So we'll talk a little bit about that briefly. So going forward here, let's just kind of begin talking about, what are some questions that we can ask ourselves when we get ready to bid on a job? And in general, when we're looking at a company, how do we set up our company as far as what kind of equipment that we have to do work? Well, one of the first questions that you'll ask when you're getting ready to bid on a job is how much does it cost to actually operate the machine on a project? So every project that you have or that you're actually going to be working on, you'll realize that there's going to be different equipment that you're going to use. You may have to use a crane and figure out ways to make sure that that's going to operate, or you may not. Whatever the case may be, you're going to have to figure out what is going to be needed for that particular project and make sure that you have everything in place and also just considering the cost as well. And then the second question that we'll look at is what is the optimum economic life and the optimum manner to secure a machine. So we're really just looking at the longevity of a particular piece of equipment and how long is it going to last? It's going to have breakdowns, we're going to have issues, lots of problems. Is it even worth getting this equipment in the first place? So we really got to think through all of that. So as you can see in this first bullet point, a few of the points here, it says provide the right equipment at the right time and place so that the work can be accomplished at the lowest cost. And that's really what we're trying to do here is we're really thinking about our schedule, we're thinking about the cost, we're thinking about overall how that's going to benefit the owner. So there's a lot of things that we consider. So just looking at that first question, I had an example, and this is basically to identify the expenses that would be actually associated with a productive machine. This is very helpful during the bidding and operation planning part. So as an example, here I have the operation and operating costs, and people call that the O&O, is usually stated in an hourly basis. And for example, let's say that you had a $90 per hour dozer that you would use, and if the dozer can push some 300 cubic yards per hour, you want to think about, what's going to be that production cost overall. So if I look at the formula that we'll end up using for production costs, I'm taking that $90 per hour, and that's how much did it cost for that dozer to use it and utilize it. And then this is how many, as far as the 300 cubic yards, that's letting me know that this is how much work that can be done in that given time period. So did I end up getting 30 cents cubic yards? So that kind of all goes into that pricing the equipment and utilizing that information to put into your bid. You would need to know that to move on to the next steps, right? So you go from that quantity takeoff to understanding, how long does it take to do something, to the amount that you would use for that piece of equipment, and all of the utilization that all comes into play, okay? So this is just, what is my overall expense for that piece of equipment that I'm going to be using? And the second question is, this is the replacement. And this is probably I would say overall, the biggest thing is that if you have a piece of equipment, you really want to think about how long am I going to actually keep this piece of equipment. Like when I was on a job site, I remember that we would sometimes rent equipment. And in that case scenario, every time you rent something, it costs a lot of money to keep it on a job site. So one of the things that we would consider was we would look at our schedule and we would say, okay, when do we need to keep this piece of equipment here on the job site, right? So if I had a schedule and I'm looking at it and I said, well, what's the optimal time period to actually have this piece of equipment here? And then you take that and say, well, between April and June, we really do need this because we're doing scaffolding or whatever the case may be. So you would utilize that time period, figure out the numbers, how much that's going to cost. And this is what we mean by the importance of machine replacement. The other factor to consider on a schedule is the breakdown side of it, okay? If you have a piece of equipment that and historically you've run into some problems using it, then, those are the things you would want to consider, especially if you owned equipment and you're really trying your best to keep that piece of equipment. And say, for instance, that on previous projects that you've had 3 breakdowns and the expense to actually fix it was a lot. So then you begin to ask yourself this question of, okay, is it worth trying to maintain this piece of equipment, or maybe we should just purchase altogether another piece of equipment? Yes, it costs a lot more in the upfront cost, but over the long period of time, I'm going to come out because I've taken the time to invest in equipment, and that's going to save me on money because I'm not going to have so many breakdowns. And it's kind of crazy in our industry because, you can't really do any kind of job without having equipment in place. And if there's anything that you see that's going to cause those type of problems, your profit is just going to go out the door because, if you're running into breakdowns constantly, then, it's kind of just say, what's the point of being out there? You really need to figure out how I'm going to mitigate this and mitigate it as quick and as fast as possible. So you do want to identify those optimum points in time to actually replace a machine. If it's really, you're in a situation where it's really hurting you more so than being beneficial and helping you out, then you ask yourself, well, maybe it's just that time. It's that time to break down and just buy some more equipment. Now, there is that other side of it where you may be actually renting or leasing. And so even with that, there are problems that can be associated with it as well, okay? So moving forward here, overall, what's very key is that the money a company spends for equipment is an investment. At the end of the day, it is an investment, especially if this is a piece of equipment that I'm actually going to purchase and we're going to actually have this in-house. You really have to think through, is it worth the investment? If you know that you use it constantly on every single project, then yeah, maybe it is. It's probably very useful to you, to your company. But, if it's something where you use it every once in a while, perhaps, maybe renting is the best route, So we're looking at it from the investment side of it, but the other side is, which must be recovered as a machine is utilized on projects. So we're looking at a standpoint of utilization. longevity. All of those things are very key. So equipment cost equals your ownership cost, plus it's also your operating costs. Okay. As I was stating earlier, going into the various ways in which your cost does become a factor with equipment. So you could purchase it where this typically is going to be the lowest hourly use charge because it's yours, it's in-house, you have a little bit more flexibility on using it. But the big thing is that there's this challenge to keep equipment fleet busy sometimes. And, you know, you have to ask yourself, you know, if I'm not utilizing this piece of equipment enough, then was it even worth purchasing in the first place, okay? Other side of that, and I don't have it on here, is training. Let's say I have this great piece of equipment, but at the same time, I have a management team, they don't even know how to use it, or I have a laborer that decides to get on this piece of machinery, and lo and behold, they go and mess it up, and you have a breakdown. So we really have to also consider, do we have the right resources in place before we actually go and purchase this piece of material? Do we have the right training in place? And are we training everyone? Sometimes you have to have certifications and different things to that nature. Leasing and also renting, those are some things that you might want to consider as well, and a lot of people do this. For leasing, higher use, you have higher use charge than actually owning a piece of equipment, but there's a lower risk involved than actually owning. So, I mean, you have to really figure out, looking at your project specifically, is it worth, you know, buying or, you know, maybe leasing or renting? It's a better thing to go with. Now, usually when you rent something, it's going to be, yes, the highest use charge, but it's going to be relatively over short periods of time. And that's a big difference there, okay? So now let's go and talk just a little bit about some of the main categories for plant equipment and tools that you would utilize. They're really priced in 3 different categories when we're talking about estimating. And that's talking about plant equipment and tools, okay? The first category that we'll talk about is going to be your small tools allowance, or some people call this our first-hand tools. Here with the small tools, they're usually priced as a percentage of the total labor price of the estimate. So as a standard equipment that is really commonly manufactured and available to prospective purchasers with, you know, readily accessible spare parts. So this is what we're talking about when we have some of these smaller tool allowances, okay, blades, drill bits, things to that nature. And then we get into the second category, which, you know, we're looking at more of the larger expense items, such as your cranes, things to that nature. So we do have to consider the difference between what type of items that we're talking about here, okay? As you can see here, though, I gave you an example at the bottom where it's talking about how you would actually take this information. Usually your larger items you would see towards an area where it says equipment, right? So if I'm looking here, I'm going to put it under like the general conditions location, and if it's a larger item, that's probably where I'm going to place it. And some of the additional things, like on the smaller tools, probably going to put that towards the end because it's just additional things that we're adding to our overall summary for our bid estimate, okay? And then the last one that we've got is basically special equipment. And now this would be equipment which has to be, you know, manufactured for a specific project or which does not have readily accessible spare parts. So some of that process, if we were to talk about the process of special equipment, so you would ship to the job site, you would use for whatever that specific task is, and then you're going to ship it back to the source. So here we're talking about excavation equipment, cranes, lifting equipment, things to that nature. It's something that you would use it specifically for that particular project that may be just a specialty type item. Okay. Now, the other thing that we have, we'll talk a little bit about the way in which you would express the unit prices. So we've got where you can use hourly, weekly, or typically monthly rates, and that's pretty normal, you know, across the board in our industry. A couple other things is, you know, when you're trying to figure out, should I rent this piece of equipment or should I purchase it? There are a couple of things that you really have to think through. You know, buying construction equipment, it's really justified only where the investment promises an actual net benefit in comparison with the alternative of renting equipment and also investing your cash in other places. In all actuality, do you have to have actually own equipment? No, you don't. So as a construction company, you don't have to own any kind of equipment in order to have a successful company. There's plenty of construction companies that are out there, they don't own their own equipment. And they're doing just fine. So it's just really, you know, the way that your company's set up. Perhaps you're a really big company and you take on some really big jobs. Well, yeah, you know, maybe it's going to be beneficial for you to have equipment on hand. And maybe that's a part of your services that you have. Maybe you do self-performed work and you have this equipment in place. I mean, maybe that's one of your selling points or in a way that you're going to add value to your client at the end of the day. But some of the advantages of rental would be large inventory, and you know, you don't really have to worry about maintaining. There's always going to be that continuous access, little need for storage, reduced maintenance, simple accounting for costs, and also just insurance savings in the long run. Estimating full ownership costs, some of the things that you would need to think about would be depreciation expense. I think the depreciation is probably one of the biggest things because, you know, it's kind of like buying a car. Once you drive off that car, it immediately, it depreciates. And you have to think about the expenses that are going to go along with buying a piece of equipment. With that, it's going to come maintenance and repair costs. And then the finance expenses, and we have to consider taxes and insurance. Where am I going to store this piece of equipment? Am I going to store it at my main office, or are we going to have a place to accommodate it? Then on top of that, you also had to consider any kind of theft that's going to come into place, fuel and lubrication costs. So it's really kind of a hard decision to kind of figure out what's going to work out. But at the end of the day, I think that as a company, you should be able to evaluate your situation and know what's going to work for you. Now, what I wanted to do now is just kind of talk a little bit about depreciation. And what is depreciation? Really, if we look at it, depreciation is a decline in market value of an asset. The asset costs a certain amount to acquire, right? So you have your upfront initial cost. And then the asset will be used for a number of years. So we have what we would call the useful life of that piece of equipment that you bought. And then the asset will then be sold at the end of a certain amount of time period for a sum of money. And we like to call that the salvage value, okay? Now, if you're a little not sure about some of the terminology, we have the salvage value here. The salvage value is really that estimated value that the owner is paid when the item is sold at the end of its useful life. Okay, so it's not, a lot of people are like, well, what's the difference between depreciation and salvage? A lot of it also has to do with tax purpose as well. So the salvage value is used to calculate depreciation expense on the tax return as well. I mean, that's another thing to consider. So the value is based on an estimate of assets value, or the value can be determined by a regulatory body such as the U.S. Internal Revenue Service, or IRS. Now, there are three main methods that you can use for depreciation. You will go through this in your administration class. So I'm just going to touch bases on it. In that class, you'll actually go through problems and solve those problems. I'm just going to touch base on it in here so that we're still, familiar with the terminology. So when we say a straight line, where we're really looking at the allocation of equally use per year over a useful life of the asset. Then we get into the declining balance. That's annual depreciation amounts actually decline as the asset gets older. And then, of course, we have the last, which is production or use. Depreciation value in a specific year depends on asset use in that year. So what does all of that mean after I've kind of went over it? Let's look at a few examples here. With the straight line, this is usually the most common method that we use for calculating depreciation, okay? So what I've given you is I have an example. A company, they buys a machine at a cost of $5,000. And that machine has a salvage value of $1,000 and a useful life of 5 years. So we're predicting that it's going to take right around that 5-year time period, and you're going to have a salvage value of $1,000. So if we were to look at this, we find first thing is that we have that, like we said at the beginning, the initial cost. A company buys a machine at a cost of $5,000. And the next part is, the useful life. We're thinking about that. We know that that's going to be for 5 years. And then we have the salvage value. What's going to be at the end? It says $1,000. So based on these three assumptions, we can then use this formula that's here. Annual depreciation equals your initial cost minus the estimated salvage value over your useful life that's been estimated. So if we were to take and put those numbers in place, we end up getting $800 per year, okay? That's the way in which we're seeing this depreciate. And so what I did is I created like a little graph for you so that you could actually see it. So if we were to actually look at this in time, from year to year, as we're going down here, we can see how that $800 depreciation for this year is subtracted out every year. So you have your initial cost of $5,000, right? And the next year you subtract out that $800, and it keeps going down and down and down to where we then have a salvage value of $1,000 at 5 years. Okay. The next is called declining balance depreciation. Here, really, when we think about it, we should say it's twice a straight line percentage, basically. Okay, so as an example, we have an asset costing $20,000 was estimated a useful life of 5 years, like the other example, and then at the end of that time period, we have a salvage value of $4,500. So we then calculate the depreciation for the first year of the life using double declining balance method. So as we look here, and we can look at the solution here, our straight line depreciation rate would be 1 divided by 5. So it's over a 5-year time period, and that's going to equal out to 0.2. So we're right at 20%. So if I were to say 2 times 20%, and I doubled it, right? Since we're saying we're going to double our straight line depreciation, that gives me 40%, right? So then my 40% take the initial cost, which was $20,000, I'm going to get $8,000 in depreciation. So it's a lot more so on the front end, and then as it goes on, it starts declining, which that's why they call it the double declining balance method. And then the last one we have is production or use depreciation. It's not a function of the age of the asset, but it's more or less the value in a specific year that depends on the amount of the asset in use in that year. The first thing is that the number of units of work the asset will produce over its useful life is estimated, and that's going to be the very first thing. And then the second thing is that the depreciation in any given year can be calculated then by multiplying the number of units produced in that year by the depreciation amount per unit. So I have this formulas that are set up here where I have the estimated number production units. That's going to equal out to the number of units produced by the asset over its useful life. Okay. Add the depreciation amount per unit. That equals initial cost minus their salvage value, and then divide that by the estimated number of production units. And the last is the depreciation in years. Okay. So as an example for this one, it's a little different, but the total initial cost of an excavator is $250,000. The useful life is expected to be 5 years, so we know the useful life. And then the estimated salvage value is going to be $150,000 at the end of this period. It's estimated that this unit will excavate a total of 10,000 cubic yards over its useful life of 5 years. And the unit excavates 2,800 cubic yards in the first year of operation. So we're going to just look at this first, and we'll look at the overall depreciation amount per cubic yard. So I'm saying 250, and then we have plus or minus 150,000. You divide that by 10,000. I get $10 per cubic yard. Okay. Now, if it is estimated that the unit will actually excavate a total of 10,000 cubic yards over its useful life of 5 years, and a unit then excavates 2,800 cubic yards in the first year of operation, then we begin to start utilizing the other formulas that I mentioned earlier. So we'd go here, we have our $10 per cubic yards. Depreciation in year one then would be 2,800 times 10. That gives me 28,000. Now, these are all different methods that we can use, but like I said, the straight line method is the one that we typically use, and these are just some additional ones. So if you were to buy or purchase a piece of equipment, you can utilize some of these formulas to help you figure out, where am I going to be in 5 years? And if you need to go ahead and do like a cost analysis and just kind of see, then this could be very helpful to utilize these methods. Now, like I said, some of the stuff that I'm giving you is just somewhat of an overall summary of what you're going to be doing in your semester project. So the last 5 slides here, I'm really not going to go through them. I'm going to let you read them in your textbook. But these are basically additional things that you would need to consider when you're providing your overall bid. And so one of them would be, of course, what's going to be my maintenance and repair costs, okay? We've got to look at that. What are my financing expenses, okay? One of the big things with this, of course, if, it's financed by a loan, so then you got interest charged on that loan, and that could really be something to consider for a business, especially. You want to always make sure that you have enough cash on hand whenever you have any kind of business and whatever projects that you try to bid on. So yeah, it's great to bid on projects where maybe I'll end up getting the one project I can bid on is $10 million. Sounds great, but if I don't have all the resources in place and I know that I have a loan in place, I don't want to utilize all of my money, right? I want to make sure that I have something left over so that I can pass it on to other jobs and spread it out. But so you don't want to really get yourself in a bind where you run into problems financially. So having that cash on hand, you can't go wrong, put it that way. Cash, that is the deal. You need to always make sure you got enough capital in place to do these projects. Other things to consider would be taxes, insurance, your storage cost, fuel and lubrication cost, equipment operator cost. All of that's important. And then, of course, we look at your company overhead costs. All of this is important to include overall for when you have your estimated summary for your bid. If you don't include those things, then you're not really helping yourself out. You're not going to make the kind of profit that you would like. It doesn't make sense to bid on a project when you know that you're not going to make a profit. So it's very, very, very important that we include these additional costs into our summary. To be truthful, there really is no best or standard piece of equipment for any particular job, okay? I'm not going to sit up here and tell you that you absolutely need to have X, Y, and Z for this job. I think it's very project driven, whatever kind of project type it is. I think also it's your experience level that has something to do with it. Historically, looking at what you've done in the past and what worked and what didn't work, those are all factors. And also, no constructor can afford to own all types and every last piece of equipment that's out there, because there's so much that's out there. There's things that I probably haven't even heard of, but there's so much work so much equipment that you could use to actually perform projects and do the work. I think that at the end of the day, you really just have to look at it, step back and say, these are the things that would really benefit if we were to own this piece of equipment. And it may be better for me to go the rental route or leasing. And you just have to weigh your odds and really evaluate the risk of every project that you work on. And I think if you do that, you'll find that in the end, you're going to be pretty successful. So this concludes information on equipment costs. And we'll talk a little bit more about this throughout the semester. Thank you.